Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, thanks for having me. It's definitely a wild time to be looking at the data right now.
It really is. I mean, we are seeing the NASDAQ just swinging wildly all over the place. But, the cost of market insurance like protecting your portfolio has just completely plummeted.
Right, it's totally counterintuitive.
Exactly. It's like investors are essentially driving 100 miles an hour blindfolded. And today, our mission is to figure out why they're doing that. We're looking at a phenomenon in the current data that, it really can only be described as asymmetrical complacency.
Asymmetrical complacency. Yeah, I like that term because it's a fascinating disconnect. We're in this market environment right now where the actual day-to-day price action is incredibly volatile,
Super bouncy.
right? Super bouncy. Yet everyday investors, and honestly even institutional traders, are just completely ignoring the need to protect themselves.
Yeah.
Like they aren't hedging their portfolios at all.
Wow.
The whole vibe out there is heavily skewed toward this assumption that the market, especially the tech sector, has just entered this permanent upward trajectory.
Like it can never go down again. Well, let's dig right into the hard data from some recent market analysis. So, looking back roughly a month ago, there's this massive discrepancy that highlights this exact behavior.
Yeah, the volatility numbers.
Right. So the analysis points out that the Nasdaq's actual volatility, meaning, the realized historical swings the index actually took up and down, was sitting at 34.4%.
Which is pretty high.
It is. But the implied volatility, which is basically how much investors are willing to pay in the options market to protect against future swings, was only at 23.2%.
Yeah, and that 11% gap, that tells a very specific story about human psychology. I mean, actual volatility is basically the rearview mirror, right? It's the mathematical reality of the bumpy road the market literally just traveled. But implied volatility, that's looking through the windshield at what the market expects the road ahead to look like. And it dictates how option sellers price their insurance based on that expectation.
Okay, so usually those numbers match up better.
Historically, yeah. Implied volatility usually trades at a slight premium to actual volatility because, people naturally pay a little extra for peace of mind against the unknown.
Makes sense.
So when implied is significantly lower than actual, it means the market is collectively just shrugging off the turbulence. They don't care.
To put this into an everyday perspective for you guys listening, it feels like driving down a major highway, let's say I-95 or something, that is currently famous for massive potholes, endless construction, just incredibly reckless drivers.
Total mess of a road.
Right, a total mess. And your car is physically bouncing around. That physical bouncing, that's the actual volatility. But for some completely inexplicable reason, your car insurance company calls you up and offers you rock-bottom premiums on collision coverage. I mean, they are practically giving the policies away. The implied volatility is low because absolutely nobody on that chaotic highway is bothering to buy coverage.
Right. The insurance company lowers the price just because demand has totally evaporated. Nobody wants it. And in the financial markets, this car insurance takes the form of put options.
Put options, right. Let's explain that simply.
Sure. A put option basically gives you the right to sell an asset at a predetermined price. So it creates a financial floor if the market suddenly drops. But because investors are not purchasing these puts, the premium required to buy that downside protection looks historically cheap right now.
Now, if car insurance is suddenly dirt cheap, my natural instinct is to lock in a massive policy. Like if the options market is offering downside protection at a huge discount, it just seems like an obvious move to scoop up those cheap puts.
You'd think so, right?
Yeah, it looks like an incredibly asymmetric bet in favor of the buyer.
It is the logical assumption, for sure. But it kind of ignores the mechanics of how options actually function, which is a trap for a lot of market participants.
How so?
Well, cheap options do not equate to a free lunch. Just like an insurance policy, if you buy a 6-month term and you don't actually crash your car, that premium you paid just expires completely worthless.
Right, the money's just gone.
Exactly. In the options world, we refer to this as theta, or time decay.
So the clock is always ticking against the buyer.
Constantly. I mean, the value of that option premium melts away a little bit every single day.
Wow.
So if the market just stabilizes, moves sideways, or slowly grinds higher without experiencing a sharp drop, buyers of those cheap put options are going to watch their entire investment slowly bleed to zero. Option sellers are very aware of this dynamic.
Ah, so they're willing to sell the insurance cheaply because they're betting the time decay will just eat the buyer's premium before any real disaster strikes.
You got it.
Okay, so even a discounted insurance policy is a guaranteed loss if the house doesn't catch fire. But considering how bumpy the road actually is, with realized volatility up at 34.4%, the refusal to hedge still seems irrational.
It definitely is.
I mean, the market isn't ignoring the potholes purely to save a few bucks on option premiums. There has to be a deeper psychological blind spot driving this behavior.
Oh, there absolutely is. And that blind spot is deeply tied to the mindset of the modern tech investor, specifically when it comes to artificial intelligence.
AI. Of course it's AI.
Right. The lack of demand for put options stems from this collective belief that the market is currently equipped with, like, an economic invincibility shield. Investors look at the AI sector and genuinely believe that any macroeconomic shock, any market drop, will be instantly counteracted by the sheer transformative power of AI.
So every dip is just aggressively treated as a buying opportunity rather than an actual warning sign.
Precisely. The logic out there is, why pay a premium to insure the portfolio when history over the last several quarters has proven that the market will magically repair itself the moment it takes a hit?
FOMO is taking over.
Totally. The fear of missing out on the AI rally has completely eclipsed the fear of capital loss.
But if we look objectively at the market behavior over the past year, that strategy has been consistently rewarded. Investors who bought the dip during moments of panic have generated massive returns.
They have, yeah.
Let's look at the data from the analysis covering July 8th, 2026. There was a major geopolitical scare in the morning. It was significant enough to rattle the broader markets, sending the S&P 500 down 1.1% during the trading session.
And just for context, a drop of over 1% on the S&P 500 intraday indicates real, palpable fear across a really wide swath of the American economy. It usually signals broad-based de-risking.
People are selling everything.
Yeah.
Yet, despite that broad market fear, the NASDAQ 100 completely shook it off and actually closed the day up 0.2%.
Which is wild.
It is. The tech sector effectively ignored this very real geopolitical catalyst that was dragging down the rest of the American economy.
Well, it was able to ignore it because the index is functioning in a highly, highly concentrated manner right now. On that specific day, heavyweights like NVIDIA and Broadcom absorbed massive inflows of capital.
They just soaked it all up.
Basically, yeah.
Yeah.
They essentially put the entire NASDAQ on their backs and carried it to a positive close. Broadcom, in particular, was heavily boosted by market expectations surrounding a massive $30 billion long-term parts contract with Apple.
$30 billion. I mean, a contract that size provides a massive amount of forward revenue visibility. It makes total sense why capital would flood into a company with that kind of guaranteed cash flow when the rest of the world looks so uncertain.
Exactly. It creates a perceived safe haven. Investors saw the broader market dipping, decided they wanted absolutely nothing to do with traditional industrial or consumer stocks, and instead they just poured their capital directly into the AI giants. They view companies with these massive multi-year infrastructure contracts as insulated from short-term geopolitical noise.
And that dynamic perfectly illustrates the complacency we were talking about. If you hold a NASDAQ index fund, you feel entirely protected from global shocks. But this brings us to the structural mechanics of the market right now.
It's a dangerous setup.
Yeah, think of it like this. Building an index this way is essentially like constructing a massive, sprawling mansion, but instead of pouring a wide, solid concrete foundation, the entire multi-story structure is resting on just 3 or 4 giant load-bearing pillars.
Right.
And in this scenario, those pillars are NVIDIA, Broadcom, Microsoft, and Apple.
And the structural danger of a narrow market like that cannot be overstated. The NASDAQ 100 is not a democratic representation of 100 companies all pulling equal weight. It just isn't.
It's very top-heavy.
Exactly. It's market cap weighted, so it's heavily dominated by just a handful of tech behemoths. When you concentrate that much capital into a few specific pillars, those companies have to execute flawlessly every single quarter.
Because if one of those load-bearing pillars actually cracks, say, I don't know, a massive earnings miss from NVIDIA or a regulatory crackdown on Apple, the lack of market insurance we discussed earlier suddenly becomes a huge systemic issue.
It creates a cascading effect. Because implied volatility was so low, institutional and retail investors didn't buy put options. They have literally no safety net.
Nothing to cash them.
Right. So when a pillar cracks, the only mechanism they have to stop their financial bleeding is to aggressively hit the sell button. And that forced selling triggers algorithmic trading, which triggers margin calls, which forces even more selling.
The whole roof caves in.
It caves in rapidly, precisely because the collective market assumed it was structurally impossible. I mean, we saw similar mechanics play out during the unwinding of the dot-com bubble, where concentration in just a few telecom and internet darlings masked the underlying fragility of the broader market.
So the danger here is unprotected optimism operating at maximum leverage. But to crack a pillar like that, given the billions in revenue these companies are generating, it really requires a significant external force. The tech sector doesn't exist in a vacuum, right?
No, not really.
And the most severe threats often come from completely outside of Silicon Valley.
100%. The macroeconomic environment is the ultimate arbiter of tech valuations. A company can have the best AI chips in the entire world, but if the global economic machinery seizes up, their valuation multiples will compress aggressively.
And according to the analysis from July 8th and 9th of 2026, we saw exactly the kind of external shock that tests this fragile architecture.
We really did.
There was breaking geopolitical news regarding the Middle East. The fragile ceasefire between the U.S. and Iran collapsed, and President Trump announced that the memorandum of understanding between the two sides was officially over.
And the commodity markets reacted violently and instantly to that policy shift.
Looking at the data, Brent crude oil spiked by 5.2% immediately following the news, crossing $80 a barrel intraday and eventually settling above $78.
That's a massive move for oil.
Huge move. And this is where the invincibility shield finally faltered. The semiconductor index, the SOX, dropped nearly 5%, and the broader NASDAQ fell over 1%.
And that is the exact scenario where the lack of implied volatility pricing catches the market totally off guard. The external shock didn't come from a failed AI model, it came from a barrel of oil.
So let's map out the exact mechanical chain reaction here. For a beginner listening to this, a geopolitical conflict over oil in the Middle East seems, on the surface, entirely detached from the valuation of a silicon chip designer in California.
Sure, it seems super disconnected.
Walk us through the transmission mechanism. What connects an oil spike to a tech sell-off?
Yeah, the transmission mechanism is actually quite direct when you look at the fundamental layers of the economy. It all begins with a supply shock. Geopolitical conflict in an oil-producing region directly threatens the global supply chain of energy.
Right.
When supply is threatened, the price of the commodity rises sharply, which is exactly what that 5.2% spike represented.
Because oil is the baseline input cost for almost everything in the physical economy.
Exactly. When energy costs rise, the cost of manufacturing, global shipping, raw material extraction, and running physical factories, they all increase simultaneously.
It's unavoidable.
Right. This broad-based increase in input costs forces companies to raise prices, which mechanically generates inflation across the broader economy.
And once inflation data starts trending upward, the central banks are forced onto the battlefield.
Right, because the Federal Reserve's primary mandate is price stability. If oil-driven inflation threatens the economy, the Fed's main tool is monetary policy, specifically raising interest rates or keeping them higher for a much longer duration than the market anticipated.
Just slow things down.
Yep. Higher interest rates increase the cost of borrowing money, which is intended to cool down economic activity and tame that inflation.
And this is where the shockwave finally hits the tech sector, specifically regarding capital expenditure or CapEx.
Right. Artificial intelligence is not a low-overhead software endeavor. These companies are not just a few engineers writing code in a garage anymore.
Far from it.
They are building sprawling, multi-billion-dollar physical data centers. They're purchasing tens of thousands of specialized GPUs, securing massive tracts of land, and installing industrial-grade cooling systems.
It's heavy industry at this point.
It really is, and that level of CapEx requires borrowing enormous sums of capital. When the Fed keeps interest rates high because of an oil shock, the cost of servicing the debt to build the AI future just skyrockets. Profit margins get squeezed aggressively.
So the physical infrastructure required to run the virtual future suddenly becomes prohibitively expensive.
Yes, and there is also the mathematical reality of the discount rate.
Explain that for us.
So, high-growth tech stocks are valued based on the massive profits they are projected to generate 5 or 10 years in the future. Financial analysts use a discounted cash flow model to determine what those future dollars are actually worth today.
Okay.
When interest rates are high, the discount rate applied to those future earnings is much steeper. A dollar earned 10 years from now is significantly less valuable in today's terms if you can get a high risk-free return in Treasury bonds right now.
Ah, so the math itself turns against them. The external shock originates with crude oil, travels through the global supply chain as inflation, forces central banks to hold interest rates high, and ultimately lands like a sledgehammer on the valuation models of tech companies.
Exactly.
And because the market was completely blinded by AI optimism, nobody bought the cheap put options to insure their portfolios against this exact transmission mechanism.
They just left their portfolios completely exposed to the macroeconomic weather.
So, how should an everyday investor actively manage this exposure? Let's relate portfolio protection back to managing a standard household budget.
I like that.
You don't buy a fire insurance policy for your home hoping that your kitchen actually goes up in flames. And if you survive the entire year without a fire, you don't look back at the premiums you paid and consider it a waste of money.
Right, you accept it as the necessary cost of sleeping soundly.
Exactly. Yet, in the financial markets, investors often feel a profound sense of regret or frustration if their hedges or defensive positions lose money during a bull market.
That psychological hurdle is immense. Investors despise looking at their brokerage account and seeing a red line item, even if that specific position is functioning perfectly as an anchor.
Right.
But the data from this options environment provides a really clear framework for navigating the risk, and you don't need to become a professional derivatives trader to do it.
What's the first step?
It starts with understanding that managing risk is about reducing vulnerability, not eliminating your investments entirely.
So don't panic sell.
Well, do not panic sell. Moving your entire portfolio to cash because you fear a market correction guarantees you will lose purchasing power to inflation over the long run.
The goal is to weather the storm, not abandon the ship. Which brings us to a pervasive trap for retail investors, the diversification illusion.
This is a huge one.
An investor might look at their portfolio and see an S&P 500 ETF, a NASDAQ ETF, and maybe a specialized AI ETF. On the surface, it looks like three distinct buckets of capital.
But if you actually look at the underlying mechanics of those funds, they are almost universally market cap weighted. That means the largest companies dictate the movement of the entire fund.
Right.
In reality, that investor hasn't diversified at all. They have just purchased NVIDIA, Microsoft, Apple, and Broadcom in 3 different wrappers.
It's like trying to eat a balanced diet by buying 3 entirely different brands of breakfast cereal, only to read the nutrition labels and realize the primary ingredient in all 3 boxes is just refined sugar.
That's a great way to put it.
You aren't getting a balanced meal. You are just setting yourself up for a massive sugar crash from 3 different sources simultaneously.
Yep. If those specific tech pillars experience a correction, all 3 of those supposedly diversified funds will draw down at the exact same time, which just accelerates the investor's losses. True diversification requires holding assets that are fundamentally uncorrelated.
Okay, meaning what?
It means holding companies whose revenue streams are not entirely dependent on the exact same macroeconomic conditions.
Moving beyond asset allocation, there is a crucial exercise in stress testing an investor's actual mindset before the volatility hits, because it is very easy to think in abstract percentages when the market is climbing.
Abstract percentages completely mask the emotional reality of a drawdown. Investors need to calculate the actual dollar amount their retirement account would lose if the major tech heavyweights drop by 15 or 20% in a single week.
Seeing that your account balance would decline by $30,000 or $50,000 triggers a completely different psychological response than simply acknowledging a 20% correction.
Absolutely.
Yeah.
It transitions the risk from a theoretical concept to a tangible, painful financial hit. Knowing that exact dollar amount before the market turns prevents panic selling at the absolute bottom. Uncalculated risk breeds panic during a crisis. Calculated risk breeds the patience required to ride out the volatility.
There's also a vital distinction to be made between a transformative industry and a crowded trade. Artificial intelligence is undeniably a real paradigm-shifting technology. The underlying companies are generating massive revenues and fundamentally changing how businesses operate.
Oh, without a doubt.
Yeah.
But an incredible industry can still be a deeply dangerous financial position if the trade becomes too crowded.
Right.
If every single market participant is standing on the exact same side of the boat, assuming the exact same outcome, the setup becomes incredibly fragile. When an unexpected macroeconomic shock occurs, like a sudden spike in oil prices, and everyone rushes for the exit at the same time, the fundamental quality of the companies doesn't even matter.
Investors get crushed in the stampede for liquidity. A fantastic company can still be an overvalued stock if the market's expectations have detached entirely from historical valuation realities.
It's essentially like being in the most exclusive, popular nightclub in the city. The venue might be amazing, but if someone suddenly yells fire, the architectural quality of the building doesn't matter because the exit door is only so wide.
And right now, the data from the options market is telling us that nobody is standing near the exit door, nobody is checking where the fire extinguishers are, and absolutely everyone is crowded onto the dance floor.
That is the essence of asymmetrical complacency right there. The crowd believes the music will never stop.
Which brings us to the core takeaway from our deep dive today. We started by examining the stark difference between actual volatility sitting at 34.4% and implied volatility lagging behind at 23.2%. The overarching lesson here is that a calm, cheap options market is not a crystal ball guaranteeing that the stock market will continue its upward trajectory indefinitely. Instead, it is a glaring historical warning sign of unprotected optimism. A truly robust portfolio is one mathematically constructed to survive a storm, not one that operates under the delusion that it will never rain again.
Exactly. And I actually have a final thought for everyone listening to Ponder today.
Let's hear it.
Take 5 minutes today to actually look inside your mutual funds or ETFs. Look at the top holdings. You might be really surprised to find that your so-called safety net is actually woven from the exact same threads as your riskiest investments.
That is a staggering thought to consider and a perfect place to leave it for today. Don't forget to subscribe and hit that like button.